problem is once you're in a stagflationary environment, and we're in the hyper version thereof, inflation just doesn't disappear very easily. It's a monster that's best killed small. They've already let it turn into a strapping young teenager now, and you just can't batter him.
Hello again, everyone, and welcome to another edition of Silver Bullion Television SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion over here in Singapore, where we want to help you truly secure your wealth. Francis Sun, the market sniper, joins us today. Francis is a trader that absolutely understands physical gold and silver. And Francis has over 30 years of experience in trading and has derived the Hunt Volatility Funnel trading methodology, a systemized approach that answers the key questions: what is the next most profitable trade? And we're delighted to have Francis Hunt join us here once again today. It's time to saddle up and silver up for Francis Hunt. Francis, welcome back to SBTV. How are you doing?
Great to be back with you, Patrick.
Glad to have you back on, Francis. Appreciate your time. I want to first start by getting your view on why are we seeing gold and silver getting sort of beat up, meeting up with so much resistance lately?
Yeah, but it's an interesting point. So everybody needs to the first thing whenever I answer a question like this is to fragment your time frames. So right now, short term, we are. If you're talking short-term charts, I'd be looking at anything from a 15-minute to even as far as a 4-hour, and it includes 1 hour and half-hour charts in there. Short-term gold is going to have a little bit of a rollover. We've been saying that for a bit. We combined that with the Euro USD, saying that the Euro's had too good of a run. We're going to have a little bit of a bump up on the dollar, and similarly the dollar exchange. So what you've actually got is a little bit of a spell of dollar strength. As the global economies are weakening and contracting, for which there's been clear evidence for quite some time, although the Federal Reserve hasn't wanted to represent that fact. In fact, they've just done 13 in a row, which transcends any modern era beats on non-farm payrolls, which continues to assert red hot labor markets, but what people aren't seeing is that they retrospectively readjusting these. 2 of the months this year have already been adjusted below that expectation in retrospect. And then we went and did another beat. So, you get lies, damn lies, and statistics. So there's clear evidence that, we just saw this in the Australian stats. We're trading the Australian dollar long against the yen, but there was a real harsh pullback. Unemployment number up. They were expecting 25,000 new jobs, and they lost 4,000. So, that's analysts expecting an add. And in actual fact, you're getting a reduction. So across the globe, actually, we're seeing a slowing down. About big tech. They've laid off this year so far 190,000. All of last year was 165. So, as AI comes in, lots of, and these aren't pizza delivery boy salaries. These are 100,000 to $250,000 base salary type people out of Facebook, out of whatever middle management and various other things. So there is a real culling. The housing market is slowing down. A lot of things are slowing down. And what that actually means is that liquidity is also going to be sought. Not everybody who's a buyer of gold is currently incredibly robust financially. And if they suddenly lose their job, they might have to be a seller, for example. So people chase the liquidity. Things like both Bitcoin and gold will sell off in what we've referred to as a demand-destroying event is incoming. We're waiting for it to get its name tag and to have its supreme capitulation moment, but we already feel like we are slipping down a very strong slippery slope on account of the exceedingly fast rate of increase hike. On top of that, the hyper over leveraged state of the general market. So this isn't being acknowledged, as I've said a couple of times now, by the Federal Reserve, but it is happening. And then if you look at gold, I'm going to put the charts on if that's okay, Patrick. If you look at gold in terms of where we're at now, let me just hit the share button. We're at the third visit, essentially at what is the $2,000 mark. And this is a really, really intense level, $2,000. It's not one you come across that often. And drawing with the overlay draw here, you can see it. There's around the 2,000 mark. We haven't spent much time above it. In fact, recently we had probably the highest monthly close. I'm on the 2-day chart here. If I just pivot to the monthly close, we have already had the highest monthly close so far year to date. So if we do that, and I redraw the level, we've already had the highest monthly close. So we are progressing quite steadily, but that monthly close also was not above 2,000. So when you look at the big time frame, this is our bear flag. This is where we get our call for the 19,000, my apologies, the 2,905 shout for gold. And it is a big substantial flag up, and we remain macro, which is the big time frames, expecting that to perform. So, that is already a flag break that we've already had. So this consolidation period, which has been painfully long, people forget that the high here was in and around July of 20. And this was the events of March 2020. It shrugged it off pretty quickly once it was in a serious bull market. So gold has been strong up into that high. And then since then, it's actually been a large consolidation period that we only really broke in 2023. Changing color here and just highlighting the break of the flag over there. Now you have those angled lines, but the other very important, and I would say supremely important, more important levels are the levels that are price-based. And that's what I was talking about, the 2,000 levels. And typically you get 3 attempts and you break on the 4th. Now, how far down? The next questions that many people go is, okay, if we're going to have a rest, how far down might we go? How long? How do you know it won't do what the others did? So let's just analyze the difference between this shooting star, for example, in the previous time you broke 2,000 and how hard it came back down versus what we're seeing now. Well, what you'll note is that that shooting star was extremely volatile. The price range that it covered during that period was sub 1900, and it ran all the way to almost 2070. I haven't got the exact there, but give or take. So you're talking about something that was in and around the 1870s in a single month, and then had a blow-off month from 1870 right up to 2070, so a $200 range month, and then rejected all the way back down to close. So that is a very high volatility attempt, and those typically give you big wicks and lead to substantial pullbacks. In spite of that, this was a larger than expected pullback, and it went to the base of all the way down to the base of the flag. What's different here is we've had much more hang time. This was also an isolated candle in 2022. It was a blow-up, quick spike, and straight back down. What's happened is we've had much more considered hang time, and there already was quite a strong selling candle quite high up over here this time. You can see it there, that red one in the middle. And then we reasserted again, we walked up. This was a smaller shooting star here, and then we've gone and had another shooting star. So this is more of what we call a rollover. That doesn't mean it can't come off some. And I do expect it to come off some, but I don't expect anything similar to this. And typically when saying goodbye to a key level that we're talking about, such as the 2,000 level, it's not abnormal for there to be a number of attempts and then a requirement for a degree of winding up before we say goodbye. And once again, I drop it to the weekly now, which is not quite as intense. You could see that was a very assertive blow-off run, whilst here was your blow-off candle, and this was a grind higher, consistent grind higher. That is now giving way a little bit. Let's get a line there. You can see it's now giving way, and we've broken down, and those bigger shooting stars, you had 2 there, but not as extreme as the others, are going to take effect, and you are going to have a pullback. And this is on the back of a little bit more dollar strength, and also a good run up from quite a low place. You've got to recognize that ran up from around 1800s. This ran up from the 1640s and has been non-stop up apart from one pullback over there. So this is a more considered, steady, higher highs, higher lows trend up that has run into the same 2,000 resistance but won't pull back as far. What typically happens is you get a pullback. That's just diagrammatic. It's not, I'm not calling a specific level there. At some sort of coiling structure, as it's called, we often expect HVFs, hunt volatility funnels, and then you can break and run to the upside. So the demand destroying event might dovetail with this, and this can see you sell off quite some degree on that. So that's a little bit on gold. I don't know if you'd be interested, but I think this will serve a great service, is also to highlight the gold-silver ratio. Because we've said repeatedly that the gold-silver ratio is the canary in the gold mine, and that you had a seminal turning event when you had the debt markets in March 2020 have ridiculously low rates and be hypervalued. And we said that was peak bonds, and that no more will people ever hold bonds with that degree of confidence as their go-to during a period of fear asset. And that rates are going to remain stubbornly high. This is the hyperstagflation framing that we have, which is not the 70s, much worse, because during the 70s you didn't have the scale of indebtedness that you have today. So the supply of debt is just so vast. And when I turn the eye on, you might recall from previous appearances, I've said there's a macro head and shoulder here, and you're in the right shoulder here for this turning on the gold-silver ratio. And similarly, March 2020, if I highlight the blow-off peak, you can see that's March 20. That was the peak non-appreciation for silver particularly, but for precious metals generally, and the highest appreciation for bonds. So that was bonds as preservation of capital and search for yield. And we feel that search for yield era is over, because yielding assets become so hypervalued and also so greatly proliferated that their valuations are a much more threat for downside contraction than any meager yield that they are now giving that is below, in real terms, the current level of inflation as well. So yielding assets are actually overshot and overcooked. And preservation of capital, something that doesn't yield a thing but always holds value in a hyper-stagflationary value environment, is your key goal as an asset class, which is macro, the metals. So we said when you came really strongly down here, we are going to break this fat red line at some point, and that's going to be very extreme run then to the 65 on the gold-silver ratio. We're currently in the 80s. And we don't expect it to go beyond the previous high. We expect it to turn before this high. So we'd see something like that, maybe a third bounce possibly before it goes, and then a downward break. But that downward break is going to run the 65 as matter of course. So that's going to be a substantial move. So metals stackers are going to get something very favorable in their hands coming. And the very interesting point, and I made this point with a couple of people, we have on the target 2,905, possibly a technical run of 3K on gold, on that bull flag that I've just finished illustrating. When we did the same on silver, and I'll just quickly show, this is triangulation of technical analysis, essentially. When we did the same draw on silver, we got the 46 to 48 range. So there is 45.09 through on silver. Now, that's the same technical structure that gold is in. If you do, going back to the gold-silver ratio, if you just do the maths with me, you will bounce after you've run the 65, probably, before we then go ahead and trigger this full head and shoulder. So I'll take this back to the month. So 65 will be a key pause point. You'll get a bit of a rally. It might go back up to 70 maybe, and then it'll throw down for the target that is 32, and it can even overperform to that target. But as the next step, just getting down to 65, that will represent a huge move in metals. So were we to assume that gold was at 3,000, just let's keep the math simple, at that point, and was making the target, because it's going to rally at 65, the gold and silver ratio will rally, which will mean it'll be a pause period and pullback period for both gold and silver again. of some degree. We don't know how much. You would have $3,000 gold, and you will have just run the 65 gold-silver ratio. That immediately gives you an idea of what silver will be. And if you run that maths, you'll see that it's 46. So the gold and silver coincidentally both running key targets and having pullbacks at the same time as the gold and silver ratio is likely to have its bounce up makes absolute sense. So I've made a few assumptions in that, but the confluencing of the two targets of seeing the 46 to 49 range, the $2,900 to $3,000 range, very, very nicely dovetails with the gold-silver ratio getting down to the 65. The next stage, which we're getting a bit ahead of the game, is then the capitulation from 65 through 32, where you're going to get your next reaction. And that's a further halvening in the gold-silver ratio, which would imply a further doubling in the relative performance of silver versus gold onwards from 3,000 onwards. So were we to get to 4,000 in gold, for example, and we were now at 32 or 5,000, as I think we're more likely to be, somewhere between there and 32. Once you're at 5,000 and you're dividing by 32, you're at about $150 silver. So that could be very, very interesting. But that's getting a little far ahead into the future. That silver at 46 to 49 range, the reason why that's interesting is that it's very much where gold is right now. Gold has had its third touch on its relative high and is pulling back. If and when on the next stage we get to the 46-49 ratio, silver's hit just sub $50 twice before, 2011 and in Volcker 80s. So it is a far broader spread of duration that silver will now be resting again just sub the $50 mark. Much like this, only far more spread apart by time duration. And that's when things get super exciting on the next leg through that, because then we are taking silver into all time for its entire history of existence highs against the dollar as part of the next stage. So I just thought that would be quite an interesting gambit, and let you unpack some of that.
If you're enjoying this interview with Francis Hunt and I, please consider subscribing to our YouTube channel. And if you would like to learn more about systemic wealth protection and how to truly secure your wealth, please do visit us at www.silverbullion.com.sg. Yeah, no, that's very interesting. For yourself, would you say that could be the time where you may want to go ahead and flip some of that silver over into gold when we're looking at that 60 and then that 30 ratio?
Yes, so the move already from to a 46 target in percentage terms for silver will already represent an overperformance in silver and a rundown as we are thinking to the 65 from the 80s. So on this down leg that we're short time frame, so remember I've just spoken monthly charts, weekly charts, on the more shorter time frame where we're expecting this rollover, you might find that that's a very good time when we start bottoming out of that and that's it done and it starts to turn. A very good time to maybe stack more silver this time than gold. I would still say gold should serve a role for you. I'm not calling a flippening in the rate of ascent just yet. It can still be more volatile, and many people can't cope with the volatility. And we've got this demand-destroying event that could come out of nowhere. As a reminder as to why you should continue to have some gold in there is if we have, and this, we don't do small recessions anymore, you know, not since .com do we do small recessions. These guys, you know, this is a pump and dump racket in my opinion. They just get ever more extreme in the numbers and ever more harsher washouts. And I feel or sense that the Federal Reserve is belligerent. They didn't call it, they lost all credibility, they went via the transitory, all the nonsense that they pulled. They eventually then had to acknowledge it, and they flipped to acknowledging it, and now they're belligerent. They're late to the party, and they're drinking harder than anyone else to catch up. That's how it feels. So they're waterboarding everybody in terms of economic activity. Instead of giving you 30 seconds head under the water, you're being held under for a minute and a half, and you're coming up gasping. They are going to hold the pain higher and longer until something really serious breaks, in my opinion. and then they might relent. So having been late to the party, they're going to be late to leave as well. That's unfortunately, they run behind the cycle quite clearly. And I think it's with intent. It's not incompetence. Everybody puts it down to incompetence. I think, they're going to do a lot of asset deflation. And the problem is, once you're in a stagflationary environment, and we're in the hyper version thereof, inflation just doesn't disappear very easily. It's a monster that's best killed small. They've already let it turn into a strapping young teenager now, and you just can't batter him. He just keeps coming back up at you. So they know that, and that's why they're going to be harsher on holding the inflation number down at the expense of growth and even economic contraction. And the pain that brings. So you've gone from a Goldilocks economy where you had super low consumer inflation because of globalization, the Greenspan dream of supreme productivity, he claimed, which was not entirely true, and people bringing their pets to work during the dot-com era and anything to get people changing jobs for 20% higher contracts every 6 months. That was the run-up to the dot-com boom, sort of peak dream economy of day to now bifurcating, deglobalizing. That means friendshoring. That's why I think the Mexican peso is doing so well, by the way. A lot of people moving to Mexico, they were very light on the events of March 2020 in terms of enforcement. People felt more free there. And of course, they're close and local to the States. Who knows, there might be a NAFTA, North American thing going down there. But the peso has been one of the best overall. For an emerging market economy, it's quite bizarre to many. Strong currency. So you've had this friendshoring thing, manufacturing moving away out of China. You still can't disconnect from China. They're too deeply interwoven. But they certainly want to reduce. And so that has been playing on. So you've been deglobalizing. You've also now on the wrong side of the demographics, peak boomer retirements are happening, and you've got this hypervaluation because the inflation was there during Greenspan's era. It just went into assets because everybody was mass affluent and living costs were kept artificially low because of the globalizing effect and offshoring and super low interest rates. You've got a financialization of everything. This huge cancer tumor that was allowed to grow and was pumped with sugar. And it was pumped up. And now you're no longer strapping and young, and you've got these massive growths, and you've got a similar 7 years of feast and 7 years of famine, if one wants to get biblical, to see it off. You've had 6 months of day in the North Pole, you now have 6 months of night, the polar opposite. And everything that applied that gave you that expansion now is reversed. So what has to reverse is this hypervaluation that occurred during the Greenspan era in the search for yield, which is bond assets, properties that could be rented out. Commercial property is going to be absolutely devastated. People working from home, particularly in the blue states, New York, San Francisco, you're already seeing that. So you've got all of this correctional restructuring to see out the toxicity of the binge years. And that pivots the bookmark for the binge years. Where it all ended, and you had a final surge in bonds, was March 2020. And now it's just night. It's just detox. And this is pretty much where we are. And it's the capital preservation era. However, within that, there's going to be so much capital contracting, so many capitalized items contracting in valuations, bonds and various other things, and debt destruction, because now they're going down in value bonds and yields are going to remain stubbornly high. And people are going to have, instead of a mass affluence feel where their homes are their ATM, they're going to have this mass non-affluence feel, this impoverishing moment. You're going to see the consumer retail be very hit. Now that's a very difficult market for gold to shrug off when we have the key moments of collapse. So there will be pullbacks along the way. So we could have, as I say, it could even get slightly disorderly on them. But what I have noticed is that silver is no longer falling as disproportionately faster than gold. So you saw that gold-silver ratio, even though gold's pulling back, it has rallied, but it's not gone. It's not going to take out that previous high in our opinion. If it does, our right shoulder comes under threat for our macro head and shoulder, and we'll have to review. But we think we're going to be down at 65, potentially this year at some point. But it could first be a bit of drama in between that comes, and it'll be masked by geopolitical events, possibly an escalation of this war with Russia, etc., etc. Who knows? They won't want to. They're going to want to lay off the need to financially reset on some geopolitical event, blame it on Russia, North Korea, Iran. There's going to be this attempt to mask, so that they say we had to do this because.
Francis, should the Fed look to slow down with the rates, maybe even reverse course and start dropping rates? Is that going to save the valuation of the assets, or is there nothing really that the Fed can do at this point?
They could, let's say they turned on a dime. I mean, they've turned on a dime eventually acknowledging inflation. Let's say we have a violent downturn, people can't sell homes, you're having 50% reduction on peak on certain areas and 30% in most others, and banks are got underwater assets again and all of that, kind of subprimey type feel with a bit of dot-com type feel with the adjustment on the big tech as well. What you're probably likely to see is it'll go on a bit longer before they react, but as and when they do, eventually, they could react quite abruptly, but I don't think they'll ever be able to drop the rates, because in spite of that contraction, you're going to find that commodities are not going to go down near as far. What's happening is we lost a lot of our ability to supply on two things. We shut the planet down for 2.5 years, which killed things like offshore drilling, mining, and many other things. And now we're bifurcating, we're splitting the global supply chain and saying we don't want to be getting these things from these countries. So, it's quite a determined effort to make sure that supply is actually far more constricted. So in a constricted supply environment, the price doesn't adjust as far down as when you have multiple sources and you can choose the cheapest in a demand. So what will happen is the interest rates will go down, but they won't go down near as far as before. So in Dow theory, you've gone from on the interest rates, ever lower for longer interest rates and lower peaks, to a point where we've now hiked higher, and the next down leg, its low will be higher than the previous low. So you're going to be in a series of higher highs and higher lows on the interest rate side now, in spite of economic downdrafts coming every now and again.
Then how do you think that's going to affect the job market? Because if those rates stay up, it's going to be difficult for businesses to really try to go ahead and get loans to expand their businesses. So they may have to slow down a bit and let some people go.
I think you're absolutely spot on. I think if let's say we're talking about America generally, I think the job market is going to be very, very hard and very, very tight. I think the recruitment is going to be exceedingly low and layoffs regular and high. And I also feel where before it typically was the supply chain side and the low cost work, this is going to be a far more middle class routing. And you also have the technology. Many people are making the case now that AI does a lot of things to quite a highly advanced level. It's not just your call center answer responses and things. It's now getting higher, right the way to generating code and various other things. That remains to be seen, but there's that threat. And middle management, if you're not directly tied to a revenue line, and you're in middle management, I think you could be gutted. So the need for layers, hierarchical layers, are going to be substantially reduced. So project managers in IT that are no longer coalface on the coding and are not not account managers for big accounts that are bringing in revenues and servicing, they could be gutted. So you're going to have more of a middle route. It's not just going to be pizza delivery boys and AI cars dropping off your pizzas for you. It's going to be higher up, and this is going to eat more into the middle class, as my impression. So I think you're right about jobs. I think there's downward pressure on jobs, and where typically it was the youth and the poor end that got hammered, the gig job economy. It's not just gigs anymore. It's going to be the careerists, the mid-career, and even the mid-late career, senior management, mid-management, that's going to fall in a lot of corporations. And don't forget, they're going to be selling less. We're seeing a lot of technical structures on US stocks that look bearish. And I think they're going to be selling less. Take a car company like Ford. They're in a horrible inverted structure. We're expecting them to break down. They've been competing with everyone wanting to go electronic. They can't produce electronic vehicles profitably. They're making massive losses on every electronic vehicle they do, but they can't afford not to have some market share. You can't be a late entrant either. So this whole transition into this not so clean but sold to you as green vehicle, where you're going to be charging it still on coal-powered plants, not solar panels, is going to devastate legacy manufacturers. And that's something Tesla doesn't have as a problem. It entered that market to produce those cars. Others are having to retool and still maintain legacy and now this new vehicle, and they're not doing it effectively cost-wise. So it's a loss leader. So you're forced to participate in a market where you're guaranteed loss in an environment where your normal market, which does give you profits, is facing a crushed consumer, subprime auto loans, massive repo rates, climbing interest rates. I mean, this is a perfect cocktail for professional suicide for the US auto industry, especially when you consider they still have some union deals that add $500,000 each to the Teamsters and retired pensioners that other nation states don't have, that Europe doesn't have even. And then you look at the crushing yen. So we are very bearish the yen, and we're actually exceedingly bullish the Nikkei, because you have Japanese car makers, Honda, Suzuki, and others that are in very interesting bullish technical structures because they're largely export market. Their domestic market will be, moderate, 10, 15%. They export, the big industrials. And they've got a currency that's leading the charge for being devastated because their government's chosen to hold a 0.5% interest rate, supports an unsustainable 300% virtually debt to GDP debt burden, and say, no, we're holding this up, it's worth this, we promise you, we'll only raise rates as far as 0.5%, even though they're importing commodities that continue to escalate. So the US, a lot of US manufacturing industries are going to be very, very hard affected in this environment. And I've just thrown autos out there because it's something everybody can relate to. But it's not the only industry. So yeah, that's an anecdote for you to consider as well.
Yeah, it's a pretty large anecdote there. So, Francis, I mean, we're talking about jobs getting decimated. We're talking about the people's ability to work, these jobs for them being decimated. Is this where something like UBI is going to end up coming into for politicians to save the day?
Oh yes, our heroes will be there. You can rest assured to save you from the fire they started. The pensions is typically it. Pensions and the state-based medical commitments, such as welfare, Medicaid, and all of these things. You're coming unstuck. These are things on not just don't have the assets to meet the future commitments, they're actually running out of money. So you don't even have the investments value anymore. You're going to have spent every last dime soon. So, you can't even find, a highly speculative instruments where you can generate some yield for the future. You won't even have the capital anymore. And you've got a terrible deficit situation where they continue to add. I think this year was, this quarter so far was 500 billion. And so you're heading for 2 trillion. You times that by 4 at the current rate. You're heading at a 2 trillion deficit. So I mean the rate at which bankruptcy, essentially for the states, many individual states, the country, nation as a whole, and the fact that most pensions are stuffed with bonds, because the conservative asset class was, of course, bonds. And you bought bonds because they paid a yield. What ended up happening, the yield got lower, their value got higher, but that was okay because your valuations were going up. even though the yield was going down. Now you face an environment that you've got to start taking out of it. You've undercated actuarially. You gave yourself holidays and breaks. Many pension schemes actually gave themselves, the employers didn't contribute for pensions as well, like on an actuarial basis because of performance of stock market and bond market, You've had this hypervaluation. We don't need to pay in anymore. Now you get the sudden contraction on both equities and bonds. And there isn't going to be one that's going to save you, although bonds will be definitely the bonfire of most. There's still places to hide in equities. You get that, and you get these stubbornly high interest rates. You're going to kill your consumer. The corporations are going to sell less, and that's going to lead to essentially the system. And once you've got enough of the middle class flushed out and angry people, and then the inability to pay pensions, you're going to have the forced reset take place. And that's your introduction of universal basic income in lieu of original pension commitments, where they'll have some sort of conversion, which will not be very kind, but they'll be, hey, we saved the day, and that's where your social scoring and everything else they want you to comply with will be crowbarred in after a problem reaction, and then here's the solution period. So they'll leave everyone in real pain that you'll sign the dotted line in just through force of necessity. And then you'll see all the clauses that you're going to have to comply with will bite hard. So this is a blackmail game. This is hurt them hard enough, and I'll get you to give me all your wealth for your freedom. You know, I lock you up, don't feed you for a week, and then you'll sign anything to be let out. And I think that is what's coming. It's totalitarianism. It's very Bolshevik communist. It's an aggressive escalation of power. Absolute power corrupts absolutely, and we're at, unfortunately, a cyclical end of people that have been allowed to get away with too much for too long, and wish to cling on to their power. And the only way, once we know what they've done to us, is to have total domination over us. Otherwise, they fear for their own existence, and that's kind of like being locked up in the prison cell with a man who shot your father. He can't rest well knowing that, and I'm afraid we got that. So he literally has to have you shackled up because you represent a threat.
Yeah, Francis, coming up is this vote for this debt ceiling again, being either suspended or raised, whatever it is. If you don't mind, I want to call you Congressman Hunt. Congressman Hunt, how would you vote for this issue? I mean, would you suspend the debt ceiling? Would you raise it, or would you simply let it expire?
Yep. First of all, I'd make a terrible politician. I'm too prone to think, to say exactly what I feel instead of diplomacy. It's not my strong suit. I would. The point is, the key part of the question is you shouldn't have found yourself this far down the road in the first instance. But your question is, now that you're here, what do you do? I don't think there's any form of reversal. There's no getting out. You're 2 kilometers down a gold mine without a mine shaft, and you don't have the climbing ability to climb 2 kilometers out of the light. You better get used to living right where you are. And that's how I feel about the situation. I would start pursuing sound economics, knowing that it would break the system, just so that we could start practicing that which we will have to practice once the system is broken and being rebuilt. So start being what you need to be for the new era. And that would be sound financial economics. That would mean politicians can never vote for a scheme that involves spending money unless they are not voting a similar scheme out for the same amount of money. So anytime people can't buy votes with we should do more of this, we're going to give more of this to people, then it's a case of, okay, that's the total of X, who's losing X? And they could never propagate expansion, because essentially, whilst it is the central banks that are part of the cartel that have brought us to the brink here, it's also the notion of the political system that you can splurge for votes. that sees an ever greater overdraft always being extended, in that never mind me, the next guy pays for it. The whole principle that you can steal from tomorrow to live, to binge today, is what we've manifested, and we are now at the detox moment where you literally can't binge anymore. So we have to start living not only within our means, but well within our means, and that which is left over probably needs putting in gold to re-establish balance sheet for the nation state. So Congressman Hunt would stem the flow of gold from the west to the east. He would cut the cloth according to the income, and that would see a massive, massive culling of welfare that would probably reverse all forms of welfare migration taking place on the Mexican border, and seeing them all head back home, and many other schemes such as surgery on transgender, the promotion of all these inversion, perversion and social skills, the funding, and then I would launch inquiries into all these various quangos of open society and many others that have been backing, putting judges in, and various other systemic. I'd probably be shot long before I got very far, and that's kind of the grisly end of my political career.
Yeah, I can see the swamp wouldn't really like you too much, but we do. We love you a lot. Francis Hunt, before we wrap up, can you tell the good people how they can follow you, your views, and how they can learn more about the services you provide?
Thank you, Patrick. Yes, indeed. So our core raison d'etre is specializing in building wealth, protecting and retaining wealth in reset times. This economic events that we've been living through, I've kind of lived since early in my 20s expecting, because I was highly economically interested very early, and I was trading markets. This is the story of my life in terms of my profession. I've been observing this from the Faulkner era. I remember distinctly, even though I was only at school, because I was economically interested, the inflation, the OPEC events, etc. This is the explosion. The volcano is finally going to go. You know, you've grown up with the living legend. One day that will go. This is the event, and in fact, it is gurgling and spilling and spitting the lava already. It hasn't fully detonated, but it's quite clearly at full temperature. We specialize in wealth building, wealth protecting, and diversifying, because there's social aspects to this as well as financial aspects. Community building, and I say to particularly an American audience, you need to have diversification of identity, structures, as well as just holding gold, guns and bullets. It's not just bunkers, gold and bullets to be enough. You need almost to have persona entities that take you outside of your home nation. And the West is my great concern. And many of the audience, I would guess the bulk of the audience watching here, don't realize that. But the Bolshevik Revolution was huge and devastating for Russia. They've had that experience. We are going to potentially get the Bolshevik Revolution of 2020s occurring for the Commonwealth era nations and the North American states. That's Canada, America, New Zealand, Australia, and Europe, along with the UK. So these are actually places that if you live in any of those nation states, you should have an alternative structure elsewhere, which is less likely to be devastated. And I think for Americans, for example, Mexico, where we're in Panama, having structures and all of that. Anyway, there's so much to this topic. That's why we have 3 circles in our brand: the Reset Sniper, the Market Sniper, and the Crypto Sniper. You can find out more about this on themarketsniper.com. And if you just want to watch some of our stuff on YouTube, themarketsniper.com, we talk technically about traditional markets, what we think is happening next, how we're exploiting the weakness of the yen. We're currently in trades at the moment, short the yen. What are we long? And also the crypto markets as well. They can play a role for you. And of course, reset, which is what I was just discussing. Be prepared. It's going to be a larger. It's going to be it's going to scar this generation, the events that are going to come. And I don't even know the full extent of it, and I don't think anybody does. But preparing is mental. psychological good health, and it's helping others to do so is also. And you're welcome to join us by booking a call at themarketsniper.com.
All right, the market sniper, Francis Hunt. Want to thank you for your time, your colorful, candid conversation, and I'm really looking forward to doing this again soon.
Look forward to it as well. Thanks, Patrick.
That was the market sniper, Francis Hunt, sharing his views on the economy, the future of money, and gold and silver. To hear more of Francis's views, follow him on Twitter at the Market Sniper. And please see the services he provides at www.themarketsniper.com. If you like this video, please do subscribe, share, and give us a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.